what we'll do is we'll send everybody a recording and then a copy of the slides as well. But honestly, this is going to be more of a conversation, and we're hoping we get some participants. We have some people live in person with us and those of you that are out in Zoom, so we're trying to do both. So I want to introduce amazing Marisol. She's our preferred lender. She's a branch manager at Financial Partners Credit Union, and my background is banking. I know a ton of lenders, and in this business, we know a ton of lenders. But we chose to work with Marisol specifically, and the reason is she works with Financial Partners, which is a nonprofit, basically banking institution that's really member centric. So the institution is awesome to work with. And then Marisol is incredible because she really gets to know what it is that the client needs and tries to find the perfect solution for whatever it is, whether it's an investment property, your first home, whatever it is. So Marisol is going to cover the first two of the 5 questions.
Yay.
Yes. And this is us, and this is our Snapchat filter.
Yeah.
That's our Snapchat filter. Really, I mean, we're so passionate about what we do, right? Because we really want, for those of you that are out there renting and feel like, oh my goodness, the rents just keep on getting higher, right? Why do I want to buy? And a lot of people get scared, right? I don't want to buy, it's so expensive, the taxes, this and that. I hear so many obstacles, but the truth is the reason you want to buy is you want to lock in that cost of living, right? Because when you are renting, as you know, you're at the mercy of the landlord, and the landlord might decide to increase the rent. Even though there's protections, they can still increase the rent by a pretty good percentage. That'll hurt. And if they sell, guess what? You're packing and moving. We just closed on buyers that had to move 3 times in like 2.5, 3 years, because every time they moved into a place, the landlord decided to sell their property. So we're passionate. We want to get every renter to become a homeowner. The other reason is you want to create cash flow. So we help a lot of clients that buy investment properties, vacation homes that they're Airbnb that they use for themselves, and then they turn into an Airbnb. So you have that option as well. Owning a second home. Maybe you've always wanted to live in the desert, or you want a mountain home. You can use, if for existing homeowners, you can use the equity in your current home. So once you become a homeowner, you can pull money from that home, which is amazing. And you can use that to purchase another property or send your kid to college like I'm doing, or buy a car, whatever the case may be. I find this really interesting, and we wanted to share this with you, that 92% of the world's wealth and 90% of millionaires acquired it through real estate. So I don't care how much of a squirrel and how good you are at saving money. At the end of the day, you're not going to make money as fast as you can through real estate. Think about people that bought their homes. And I have this great example. We helped a client buy in March of 2020, right before the shutdown. She bought a place in Menifee, and they were scraping to make it happen. And she paid about, it was like $440. Yeah. Fast forward 2 years later, she refinances the house and it appraises for $730,000. So she accumulated so much wealth in those 2 years by doing nothing, just the fact that she was willing to become a homeowner. And since then, she got solar, she's driving a Tesla, she's living large. I mean, there's no way she could have done it on her salary. It just wouldn't have happened, but she leveraged her home. So that's why we're so passionate about it. So we're going to start off with our first question, and Marisol's going to take over with our first 2. Oh, this is a great graph before I leave. This graph shows, and if Natalie, if you don't mind, just so people here can see. We get people all the time that say that they want to wait to own. Like, oh, I'm not ready to buy now. I want the market to go down, the market to adjust. Well, look at what's happened to home prices since 1991. Yeah, there was that period, and we all know the 2008 debacle, the craziness that happened, right? That the market dropped. But even then, like, look at how much it's appreciated since then. And look at the curve. Its prices are going to go up. If you're looking for a quick buck, then maybe this isn't for you, right? We don't have a crystal ball. We can't guarantee that you're going to make $200,000 in 2 years. But if this is your home, or you plan on keeping it for 5, 7, 10 years, then more than likely you're going to accumulate wealth. So, so now I give it to Marisol.
Thank you.
Yeah.
This is a cool little microphone.
Yeah.
It's fluffy. Well, thank you guys so much for having me and always trusting me. I just want to speak a little bit about Financial Partners Credit Union and the reason why I work with them and why I work with VB Realty. So we're a credit union, we're a non-for-profit organization, and what we do is similar to what a bank does, right? We have the same products and services that they have, but what we do differently is because we don't have to give our profits to our stockholders, we give them back to our members, which translate to better interest rates for you guys, better programs, better everything that you could think of under the sun that you would do at a regular banking institution. The same thing applies to a credit union, except you are getting better interest rates in turn and better products in every single avenue, that be a savings account or a mortgage, right? So that's what differentiates us from your traditional bank to why working with a credit union. But we're gonna talk about what questions, and we're gonna get into depth into like the nitty gritty of like creative financing. How can you become a homeowner in this unusual environment that you think is unusual, but I think it's kind of the normal for now, right? So we're gonna talk about what you need to qualify for a loan. So most importantly is credit, right? So you want to be creative when it comes to your credit score. You want to have good credit because that's going to translate to better interest rates and more programs that we can offer you. The higher the credit score, the more appetite we're going to have in lending you different products, different services to get to that creative financing. We don't expect you to have perfect credit, but there's different tiers, right? So let's, for example, someone with a 740 credit score or higher is considered A paper, excellent. They're going to get the best interest rates. Anybody between the 700s and the 740s, you're considered great. You have good credit. Maybe there's something that happened, but that's okay. You're still going to get great interest rates. And anything below the 700s, we'll help you work on it if we need to get into the higher, but it's still really good credit. So we're going to help you become a homeowner no matter what. When you get into like the 620s or below, that's when I guess we say credit challenged, and there's more things that we need to do, but we still look at it and we try to help you get creative on how we can help you increase that credit score pretty quickly. The things, the models change. It's an algorithm based on your credit. There's different criterias, but credit is important. Number 2 is collateral. So the property you're going to purchase, that be your primary home. Are you going to buy an investment property? Are you gonna buy a second home, or is this gonna be your forever home? The collateral is a big important piece because obviously that's what protects the big loan that we're giving you, right? So we're giving you a loan for X amount of money, and the dwelling protects it in the event that you should default, which for the most part, it just depends on how much skin you have in the game as far as down payment is concerned and all of that. So collateral is a key. And there's so many different ways that we could get creative with your current collateral, because some people are already homeowners and they're looking to buy that second home. How can we get creative using your current home and that collateral that you currently have in order to get you into another property? Or how can we get creative in putting you into your very first home? That way in the future, you can use that as a collateral for you. So that's a key point when you're qualifying. And capacity to lend, how much income you make in comparison to how much we're going to loan you. So right now in the industry, you're hearing, oh my gosh, I don't qualify what I would qualify for a year ago or 2 because interest rates have risen, right? The majority of your payment is made up of the interest rate. So a lot of the times the qualifications aren't there, but that's where we come in and try to sit down, look at what your goals are. Maybe you're not going to buy that 4-bedroom house for the first time, but that's okay. Maybe you are okay with getting a smaller home. That's going to get you in the area that you want to be. So we get really, really creative when it comes to capacity, which is another C, creative. We should probably add that on there. 4 C's.
Creative. Yeah. 4 C's. We
get creative, especially, I think when it comes to lending, there isn't really a traditional, okay, you're going to do your 30-year mortgage. This is what you qualify for. I think for now, everybody just we need to talk about it and see what other products there is and see which one makes sense. I think tailoring it to your specific purchase and how you're going to make your homework for you, whether it could be your primary residence or your second home, that's what makes us different. That's what makes us really, really help you become a homeowner and not just, oh, okay, we're just going to, do your purchase and you're never going to hear from us again. We really want to establish a relationship with you. So that's a little bit about the 3 C's. Obviously, that was like a very big.
Can I ask a question?
Yes.
Okay. So, and if you don't mind repeating it into the mic.
Yes.
Question is, how do I know what my credit score is? Because a lot of people, we get people that say, my credit score is amazing, and then it's not, or vice versa. They think it's horrible and they actually have great credit.
Yeah, and that's a great question. So we actually do at the credit union, we do a credit review, and that's how you really, the way you're gonna really know what your credit score is we do a hard inquiry on your credit, and we tell you, okay, your credit score is this amount. But for a mortgage, we use a tri-merge credit report, which means we pull all 3 credit bureaus, Experian, Equifax, and TransUnion, and we do the middle of the 3 in order to determine what credit score we're gonna use to you know, do your application and do your purchase. However, there's so many things that are like related to your credit. So 30% is the capacity that you have, meaning are you maxing out your credit cards each month, or do you have enough capacity? The rule of thumb is to never exceed 30% of your capacity. So never be over 30% of what your balances are. The other one is 30% is made up of your repayments or your payment history. Have you had any lates? Do you have any collections? Do you have anything like that? So there's different variables that play into your credit score, but the way you really are gonna find out what your actual credit score is submitting an application and doing a pre-approval, and then you'll get a disclosure saying your credit score is X.
Okay, question. So for somebody who wants to be very mindful of keeping a healthy credit, so when they're ready, what are some of the things that have heavier weights?
For someone that's very, very mindful of their credit, so there's different things. One of the biggest questions that I get asked is, Marisol, should I close a credit card that I've had for 15 years? Actually, that can affect your credit score and really dip it, because it shortens the time frame that you've been credit established. Or it can also affect your capacity. For example, you have a total variable limit of $10,000 on your credit, and you close the one that had a limit of $5,000. Now you've decreased your capacity by half, and you owe $2,000. You're already at the 30%. So someone that's very mindful of their credit, you definitely don't want to have many credit inquiries. The rule of thumb is 3 a year. You want to have 30% or below, or 70% because capacity, 30% of balances. You want to have a good mix of credit. You don't want to just have credit cards. You want to have a different variety of personal loans, which are called installment loans, or a car loan, which is an installment loan. You want to have, and that's on your history. That doesn't mean outstanding what you owe. A lot of people hold a lot of credit cards and they don't ever get any personal loans or auto loans because they pay those in cash. That can affect your credit score as well. You want to be a homeowner eventually. That way that's being reported and you have that history. So for someone that's mindful, they want to have a good mix of credit, not owe more than 30% on their balances, and not run their credit more than 3 times a year for lending, except if you're home shopping.
When you say run your credit, like what do you mean, like max it out?
No, run your credit score to apply for something. So you gave someone your social and they actually did a hard inquiry, which you bring up a good point. So what's the difference between a hard inquiry and a soft pull? So when you give your social and you consent to pull your credit, that's when we're actually gonna pull the credit. If you have excellent credit, that shouldn't affect you too much. But for the most part, if someone has had their credit ran multiple times, that can affect you, but it all depends on what you're applying. So let's say you go out and you say, I'm applying for 10 different credit cards. That could dramatically affect you because it's telling the algorithm, I'm looking into getting to debt. When you apply to a lender and you want to apply for a mortgage, the algorithm automatically knows that you're looking to become a homeowner. So you don't get as impacted as if you did multiple credit inquiries on a credit card.
Right.
So, but a hard pull would be us pulling your credit, you giving us your social and consent. A soft pull is us you have an established account with us and we monitor it every so often, and then we give you like a pre-approval. Hey, congratulations, you've been pre-qualified for X amount of money for this type of product. That's a soft inquiry. Or another one would be if someone's doing a background check for you for a job, that's a soft inquiry. Or you're looking to get a utility bill or something like that, they do a soft inquiry. So there's that's what the ones you don't know of that they're looking at it on the back end.
No.
Yeah.
If someone knows that they have slightly lower credit,
Do you want to take the mic or repeat the question just so they could hear?
Yeah.
so really my main question is just, what is like the top couple of things that someone that has lower credit can do to boost it, to prepare to?
So her question, I'm sorry, I should have been repeating the questions. So the question is tips and tricks someone can do in order to increase their credit score. So there's different things. When we do a credit review, the most common thing that I see is balances, right? So someone doesn't have enough capacity to get them to that 70-30 sweet spot. So one thing that you can do, if you know that you only have 2 credit cards and your limit is 10,000 combined and you owe 5,000, A trick you can do is open another one that's available for you, but also have some, you know, you have to have some self-discipline. You know, you can't use it, right? So I always hear that's why I bring that up, because I always hear, Marisol, you're telling me to open another credit card and get into more debt. No, that's not what I'm saying at all. You want to keep your balances below the 30%, but maybe opening another one that's going to give you a larger capacity can help you increase substantially. Consolidating debt. There's a lot of people that have small balances on different credit cards. Maybe just take out a personal loan and combine them all and increase your capacity further in your mix of credit. That can help you increase your score. If you have a collection account that's in the last 12 months, maybe call and try to settle it. If it's past 12 months, don't touch it, because then it just restarts all over again. So every credit report is a little different, and the tips and tricks that we can give is going to be very different for each individual depending on what caused the credit downfall. Was that helpful?
Yeah.
Yes, very
Thank you.
helpful.
Yeah, and you know, this is just to summarize a little bit of how important it is, credit, in order to gain approval. So the rule of thumb is your credit score needs to be 620 or higher in order to qualify for a loan. 700 or higher if you want to get one of the jumbo loans, you know, the high or super conforming, or if you really want to get competitive when it comes to interest rates. And then 740 or higher in order to get the very best offer that's out in the market right now.
I was gonna ask you, like, other like websites, like kind of like Credit Karma, how accurate are those?
I would say that
That's a
Credit
question.
Karma.
Yeah, do you wanna repeat?
Yes. Oh, sorry. So his question is, how accurate are the credit reporting agencies, for example, Credit Karma being one of them? So I can't say that they're pretty accurate. What I can say is that they all pull from different credit bureaus. So what that means is Credit Karma might use TransUnion and they use the Vantage score, which is a different model than Experian uses, which is FICO score. I'm sure you guys have heard that terminology frequently. Your Vantage score is Vantage 2.0 is 650, and then you get your Experian score, which is a little bit more strict, by the way, and it's going to be slightly lower. So I wouldn't say they're 100% accurate, because you're getting information from different places. What's important when you're applying for a mortgage is, what you have to keep in mind is we pull all three of them. So we're going to get all three credit scores, and we're going to get the one that's right in the middle. So technically what Credit Karma pulled might be 20 points off than what Experian pulled. They're all getting their information from different avenues, if that makes sense. I don't think that they're 100% accurate, because I've had the situation where I've had a member or client say, hey Marisol, when you pulled my credit, it was actually much higher than when I was looking at it on my Vantage score on my Chase account. And I said, you know why? They use Vantage, which they're only pulling from TransUnion, and they're not getting all the information that we get from Experian and Equifax. So there's multiple. So that substantially can be lower or higher. What I think is a good way to monitor your credit is go to freecreditreport.com. You're entitled to one credit report a year for free, and they give you all of the data that's on there. If there's anything on there, you can actually dispute it directly with freecreditreport.com. That's something that's an access that's given to you every single year. So that's helpful.
We have a question that showed up on the chat, if you don't mind reading that.
Yeah, are the credit scores for the main borrowers, or is the 740 required on both borrowers? That's a great question to qualify for the best rates. So when you're submitting a mortgage and it's between two applicants, that be married partners or just co-applicants, we use the lower of the two. So if one of you has a 740 credit score and one of you has a 620, we use the lower of the two. Because there isn't something that we can do as far as a program that mixes the scores, especially if you're unmarried. So it just really depends, but we use the lower of the two currently. That's the way the model works. Good question. Is there any other specific questions that you may have on credit, specific collateral? Obviously collateral speaks for itself. Capacity, remember, it's the ability to repay. So I hear all the time, Marisol, I make $200,000. I can't qualify for the amount that I want, but a lot of people don't take into consideration other debts. So we look at their credit report, and obviously, like if you have multiple automobile loans, if you have multiple credit cards, we take all of that into consideration in addition to the taxes, the PITI of the property, right? The principal, interest, taxes, and insurance. And then in addition, everything that's owed on your credit report. And it's the minimum payment owed. So if you have student loans that haven't been paid because they were in deferment and now the payments are coming due, we're going to take that into consideration. If you have a credit card or multiple credit cards or multiple personal loans or auto loans, all those payments are taken into consideration to figure out what your capacity to repay is on the property.
Just had a quick question about the credit card. If you wanted to increase, like you were saying, your credit, like how far in advance should you do that before you actually go, try to get a loan?
So typically right now with the new model, oh yes, I'm sorry. It's hard to repeat a question when you're gonna
I know,
actually
when
hear
you're
the
looking at
answer.
me.
And then I'm looking at you. I'm sorry. So her question is, how soon do you need to increase your, so I gave a tip that if you want to increase your credit score, it might be a good idea. Not for everybody, because everybody's different, but it might be a good idea to increase your limits on your credit cards, to increase your capacity. And then her question is, how soon do you need to do this in order to, get that increase before you apply for a mortgage? And it really all depends on how quickly it's being reported to the credit bureau. They're moving a lot quicker. I will say, I had a client who we did a credit review for this person, and I told her everything that she needed to do, and then she went back home and did everything within a week, and then called me and said, Maris, okay, paid down my credit cards, I asked for an increase, I got this. Within 3 weeks, her credit score had already gone up. So it just really depends on how quickly the credit bureaus get reported to. So we have to look at the calendar, and that's something we talk about in the credit review. If we talk about it in the first week of the month and we're like, okay, every lender is going to report on the 29th of this month, or this specific lender is going to report on the 29th of this month. You should do it by this date in order for it to get reported, and then by next month, you'll be good. So it just really depends on when we have the conversation.
It's a great tip.
Yeah, great question.
Good tip.
Yeah.
Nice job.
Sure.
When it comes to the credit card,
Mhm.
how often are you supposed to, I guess, raise your limit? Is it like supposed to be like annually? Because I haven't raised mine in
There
like 3-4
isn't,
years.
so how often are you supposed to raise your limit on your credit card?
Because I keep hearing.
That was the
like,
question.
Yeah. I was like, I
I'm
haven't
gonna
done
keep
that.
forgetting, I'm so sorry. So how often, his question is, how often do you have to, or should you increase your credit limit on your credit cards? And it just depends on how much you owe, right? So for example, if you owe 0 and you have a small limit, then you're good because you have 100% capacity. So if you owe 5,000 and you have a $10,000 limit and you're at 50% capacity, it might be a good idea to ask them to see if you can go up to 12,000 or get another credit card that's going to have a higher limit, that way you don't have to worry about it. So it just really depends on A, how much you qualify for, B, how much you owe, and if you don't owe anything, you're always going to be good. So just, if you don't need it, you don't have to do it. It's not something that I love to recommend. It's just something that I know has worked for people that I've helped in the past, and I've seen that increase in credit pretty rapidly. So that's why I bring that up. Because I don't want you to get into debt, because I want to help you buy a home. Right? So that's the goal. But yes, great questions. Any more questions on collateral? Anything you want to know about specific properties? We're going to talk a little bit more about like obviously a primary residence. If you're going to live in the property, you can purchase a home with as little as 3% down as a first-time home buyer. What a first-time home buyer means is if you haven't owned a property in the last 3 years. So if you haven't owned in the last 3 years, you're considered a first-time home buyer. And it can be anything from a single family residence, a condo, or a multi-unit. Actually, the multi-unit is a great starting point because it helps you offset your mortgage payment by maybe collecting rents on a second property or third. And what also it does, it helps you qualify for more, because we're actually going to take those rents into consideration when qualifying you for a loan. So that's on primary residence. Second homes, you can purchase a second home with as little as 10% down payment. So what that means, as long as you occupy the property for a small portion of the year, 3 weeks, meaning it's technically a second home, you can buy something with as little as 10% down. They are getting a little bit stricter when validating your second home, because they actually ask for it to be a ways from your primary residence. So usually it has to be at least 60 miles away from your primary residence. However, there is exceptions. So for example, if you live in Palm Springs, like you live there, and you want to buy a second home in Palm Springs, but you're technically going to use it as like a family or like you have to show documentation in order to prove that it makes sense that you're buying a second home in the same city that you're living in. But because it is a vacation-like place, there's things that can be done in order to be able to proceed with it. It just has to make sense. Remember, everything can happen as long as it makes sense on paper and we're able to explain it. So, and it could also be a single family home or a condo, 1 unit only. So you can't buy a second home and buy a triplex, because obviously we know that is not going to be a second home. You're not going to live in each unit 3 weeks out of the year.
Maybe.
So, maybe
A different theme.
So, hey, yeah, you can do different homes. That's actually see if we can document it, we can maybe fight it. So that's on the second home vacation properties. Investment properties, you can buy with as little as 20% down. It's all gonna depend on the program. And an investment property is basically you're gonna collect rents from it. That be Airbnb or just you have a full-time tenant in the property. So that's a little bit about the types of homes that you can buy. And again, usually this primary residence gets you here and here. So this primary residence will typically help. I've helped so many buyers use their primary home to buy their second home, use their primary home to buy their investment property. And now they're sitting pretty, collecting rents and building generational wealth because they have more residential property. So we always, like I said, we sit down, we talk, maybe you should do a home equity line of credit or something of that nature in order to qualify for the next step in your life. So the next question is, what are my payment options? So there's a plethora of ways, especially right now because the interest rates are higher than what we're used to hearing, right? But then you also hear like, okay, they're not as high as they once were when I bought my house and it was 12%, right? But the prices in homes.
Yeah, we wanted to show its life.
Yes. So right now that I brought obviously the history of mortgage rates and how it's gone up annually. So in 1982, the rate was 16.63. So if you could see, obviously, traditionally, they've obviously gone down because the prices of homes have gone down. So right now our average is hovering between, up,
Yeah.
sorry, not down.
Equity.
Prices of homes have gone up. So right now we're sitting around 7.25-ish. I priced it today. 7.34 to be exact on the 30-year fix. So historically, this is where rates have trended, and we are higher than average, but statistically, we're still averaging out. So, but prices of homes, of course, are higher, so we keep that in mind. But that just means that you're building more wealth.
And Maris, this is the question everyone's gonna ask, right? Is are we ever gonna see 3% again? Like, let's just get it out there.
You bring up a good point. I don't know if you've seen the things going around.
Question.
Oh, yes. But just to tie to her question, there's memes going around about this specific question. So her specific question is, are we gonna see 3% interest rates ever again? Well, I don't know because I don't have a crystal ball, but I highly doubt it, right? Every single person that researches, that knows, they say those are long gone. We're never going to see it. If you got something in the 2s, you were the lucky one. This is the good thing that came out of COVID, right? There's one of the things that a lot of people do, but the memes that are going around are saying like, if you bought in 2020 and between 2020 and at the end of 2021, don't ever sell, right? Which is causing an inventory issue, right? Don't ever sell because you're never going to see that interest rate again. If you were one of the lucky ones to get it, enjoy it, but then eventually those people need to move and they will move, so things will happen. So no, we might never see it, but don't quote me because I don't know. And then also, but they are going to get better, right? They're not always going to stay this high. It's not sustainable, but what makes sense for you now is maybe getting in the market, because when they start dropping even slightly, once we get into the 6s or the 5s again, if we ever do, please believe that people are going to run because they think that that's just going to be the lowest again. So what are my payment options? So HELOC for existing homeowners. We talked about leveraging your primary home to buy that second property, leveraging your primary home to buy that investment property. A home equity line of credit sounds scary because it's a second lien on your property. It could be a variable loan. But oh my gosh, has it gotten people out of so many binds? I've seen so much more good that came out of a home equity line of credit than bad in my 12 years of experience in doing this. I've never seen someone or had someone come back and say, Marisol, seriously, why did you make me get that home equity line of credit? It sucks. For the most part, it's been very beneficial because they were able to use it to buy another property or another 2 properties. We have many people that are testaments to that. And they come back and say, oh my gosh, I wish I bought 3, right? It's helped people get their kids through college. It's helped people pay really, really large bills for life events. I had a client that had breast cancer that was going to be out of work for a while, and she luckily had a home equity line of credit, used that to offset her income while she was getting better. So a home equity line of credit for existing homeowners is something that you definitely should leverage. And once you become a homeowner, that's something that you can definitely think of getting once you have the ability to. What it is it basically up to 80% loan to value, a maximum of a limit of 250,000 depending on the time. Right now, that's the max. And then different loan options. So what makes up your payment? So a lot of the times people are like, okay, my lowest payment is going to be if I go into a 30-year fixed. Well, not necessarily. We can actually get creative. We can do something called an 80-10-10 program, which puts you 80% of your loan in one mortgage, 10% in a second mortgage. That offsets that balance, and then 10% down. That avoids PMI. We have adjustable rate mortgages. Just because the adjustable rate mortgage is adjustable doesn't mean the payment is always going to be adjustable. It's fixed for a certain amount of time, and then once it adjusts, that's when the payment gets adjusted. The good news is now the adjustable rate mortgages are heavily regulated. So what that means is when you actually sign for this loan, you get a document called the closing disclosure, and it tells you, okay, this is what your payment is today, and this is what your payment will be worst case scenario if it adjusts at the highest rate possible based on the term. I gotta say, the people that got an adjustable rate mortgage rate for the last 5 years or 3 years, we had a really good 10-year adjustable rate mortgage. They're sitting pretty because they can only adjust a maximum of 2% above the starting rate. Let's say the rate was 2.25, they're gonna adjust to 4.25 for the life of the loan. They're good,
Yeah.
right?
They're
So
not bad.
they're not bad
that. Yeah, sounds perfect.
because they're regulated. That wouldn't have happened in 2008 when
No.
we were offering the adjustable rate mortgages. So just to give an example, PMI or not, your loan, there's ways to avoid PMI. There's different programs that we can put you in.
What is PMI?
Private mortgage, the question is, what is PMI? And PMI is private mortgage insurance. So when you don't put 20% down on a purchase, it's always required that you have PMI to protect the asset of the lender, right? So the lender's loaning you a whole bunch of money to become a homeowner. You have to have some skin in the game, and it's been determined that usually about 20% is the accurate amount of having skin in the game. So if you don't put 20% down, that's okay, because most homeowners don't. That just means you're gonna have private mortgage insurance, and that's a percentage of the loan amount in coverage that you need. So usually it's 1.25%. So that's PMI, and it's broken down into payments for the life of the loan, or if you do a conventional loan, it's for the first 2 years or until you've gained the equity. So it's removable if you do conventional. If you do an FHA loan, you cannot remove PMI. You would have to refinance in order to remove it. And then the question of the year, I think I get this like 10 out of 20 questions. No, 10 out of 11 questions. Down payment assistance, do I qualify for it? So there's different options, and they're getting more creative. We actually have a down payment assistance program that helps our buyers cover $10,000 of their closing costs. You have to qualify for it. So there's a median income in California, it's 117,000. If you exceed that income, you don't qualify for down payment assistance. There's different city programs. So depending on where you're gonna live, there's different programs developing cities. There's different programs in Long Beach. You would have to submit an application. Once they have funding, they'll say, hey, your application is next. Here's your funding. You have a down payment assistance program. So there's many, many different options to get one. Is it really quickly available? No. Can it delay the closing? Yes. Can it help you buy something in a competitive market? Probably not, because they're not gonna wanna wait for your down payment assistance program to be approved in order to get the property. So sometimes it doesn't make sense, but we do walk you through what options you may have available to you, depending on your income and where you're looking to live.
Marisol, the down payment system, aren't they usually also very specific on where you have to buy property?
Yes, so the question is, do down payment assistance programs have a specific location where they want you to buy? For the majority of them, yes, they have developed a specific map of where you can use the program, depending on the city. So there is definitely different maps, and they narrow it down very specifically. Long Beach, I think 60% of it actually can get a down payment assistance program if you meet the median income and all the other qualification factors. So it just depends. Great questions. Does anybody have any questions in regards to what your payment options are? And again, we talk about your payments early on, like at the pre-approval table, like if we're pre-approving you to buy a home, we're talking about this because we also are very realistic and we want to make sure you're comfortable in what we're putting you into, but we also want to, like, you know, sometimes I have clients that say, okay, I don't want my payment to exceed $3,500 or $4,500. And I'm like, okay, well, what are you paying in rent today? This is what I'm paying. Multiply that by 12, and it's going to increase next year. It's either your landlord is going to sell the property or he's going to increase your rent, because they're also looking to make more revenue on their properties. They know property values are up. So either you want to stay in a inconsistent, unreliable situation, or you want to move into a situation that might make more sense. Yes, it might cost you more money up front, but later on you can always adjust that. It's not forever.
So you can refinance. How quickly can you refinance? Like,
Great
let's say
question.
you get a loan and you're like, I think rates are gonna go to 5% and I lock in right now at 7.3.
You can refinance the next day if it makes sense. So a loan, what it does is when an underwriter reviews your loan, it has to make sense. You can't just refinance just to refinance. If they see you have a loan you did yesterday and today you turn around and want to refinance, obviously that doesn't make sense because there was costs associated with you getting that first loan, right? So it has to make sense. So if tomorrow you close today and tomorrow the rates are 5%, it makes sense for you to refi, you can do it as long as you're comfortable doing. So there's no prepayment penalties on the loans that we offer. Also, it's super dependent on what type of program you decide. So for someone that's gonna pull a HELOC to purchase their second property, and then later on they decide, hey, I'm gonna sell this property, I wanna pay off my HELOC. If you don't have the HELOC for at least 3 years, there's a prepayment penalty of $500 because we don't charge you a dime to do the HELOC. So we just have to recover the cost after 3 years, $500, that's it. If you're turning around and doing your first mortgage with us, we'll waive it. So different things, obviously that's case by case and situational, but you can refinance at any time. I had a client that just literally was like, okay, I just need to close this loan today because tomorrow I'm going to do this. Natalie knows them.
Yeah. We do have another question in the chat box.
Okay.
I don't know why it's not coming up. Give me a second.
Just read it, Tara.
And I'm sorry if I talk really fast.
Oh.
I'm trying to slow down.
I don't think so. You're doing good.
Wait, sorry, it was there and then it looks like it went away.
Maybe I answered it.
Yeah. Weird, yeah, it's not here.
Oh,
It's okay.
does anybody have any questions over the phone? Maybe they could speak up
On Zoom. On Zoom.
on Zoom,
Phone, Zoom.
Chat, same thing.
tablet, computer,
Internet,
phone.
wherever you're coming from.
Can you unsend a message?
Okay.
All right, well, we can always ask.
Yeah,
them too.
yeah,
we can
ask
come back to it.
them.
Okay.
Yeah.
Come back to it.
All right.
Thank you, Marisol.
Thank you guys. Let me know. I'll be here for any additional questions, but I'm gonna turn it over to Vivon.
Yes.
Yeah.
Okay, that's good stuff. So we talk about payment and my head hurts a little bit when it comes to that. So we're just gonna talk about the next step, which is property, right? So you go through all the qualifying and then now we're ready and we're excited. We're gonna go look at homes. One of the things I do want to point out though, you know, and just hearing statistically, when people talk and we talk about like affording that monthly payment on the mortgage and feeling like it's heavier, and you know, sometimes it is, to make that jump for rent. One, eventually over time, that rent is going to exceed that monthly payment. Like your monthly payment, you know what it's going to be. And then the only thing you can do is you can refinance it, it'll get lower, but the rents will eventually, you know, exceed that. So that's something that's a bonus for a homeowner. And then they also did a research study that people who had owned homes, you decide to take the jump into home ownership, 7-10 years later are in a much wealthier position than the people who decided that, hey, I'm paying $400 less, based off of mortgage, let's say, or to rent. 7 or 10 years later, fast forward, they're in the same exact financial position. They have no gain, right? If you think about it that way. So we have to think about it. It's a great investment that you get to also live your life in and build wealth in. So I'll go through, we're working, I think the slides get a little stuck, but one of the big questions when we get to helping buyers and it's their first time buying or any buyers who are buying is, well, once we find a property, how do I know that I'm not overpaying? Because listen, all of us, we feel uncomfortable. We don't want to overpay for a property, especially in this competitive market. I see that a lot where if there are multiple bids, there are some buyers who say, hey, if I find a property I like, and all of a sudden there's 10, 12 other people bidding for it, I'm out. I don't want to do this, right? Too competitive or they're overpaying. And the truth is, in any market, you guys, in any market through the years, what you have to understand that our values in real estate have been set by buyers, right? So it's what the buyer's willing to pay for the property and what the seller's willing to let go of it. At the end, when that closes, we're doing TV. Sorry. That's gonna be the price. Sorry for the Zoom. It's our slideshow's gone, but I already know what the topic is. Okay, this is us.
I'll do it for you guys.
So that's what it is. So at the end of the day, when you're studying a market, that's what you have to realize is one, in working with us, that's what we try to help our clients is just setting the expectation, understanding what market you're buying in. And at the end, it is a long-term gain, you guys. This is not something that, I don't know, crypto or what's that? NTF art thing. It's not gonna, but that's something you can rely on. It's not gonna make, we can't guarantee it's gonna make 200,000, like I said, in 2 years, but we have known if you look any time through historically, you're going to gain, that profit. So the important thing is, and we'll go through the quick is, just understand that when you're buying properties, you're buying all cash, you're getting a loan, right? So one, the bank is going to be just as heavily, obviously more invested in you. You are using, let's say 10, 15, 20% of your funds, but just think of a bank putting 80%. So of course, they're not going to want to overpay for a property. So when you're getting into making an offer, one, we will always, before, what we like to do is look at the property, look at the comparables. Comparables are properties that have closed that are similar to what you're looking at. When we look at condos, we always say, hey, it's going to be the units that are inside that complex are going to be the best match. We look at neighborhoods, we look at lot size, we look at improvements. And when you are ready to make that offer, we give you our opinion, we give you our guidance on where we think that's going to be. So if a property is, let's just give a number, let's set 700,000, we're doing our due diligence and we're advising you and saying, hey, they listed at 700,000, but all these homes are very similar, just closed within the last 4 months at 800,000. Guess what? Then you probably should write an offer where it needs to be at 800 and the seller just underlisted it. And we're advising you so you don't have the expectation of, hey, you're gonna get 700,000 because you're not, right? So we're having that same flip. Is there some sellers who are aggressive and say they want to list their home at $1 million, but we're looking at it and we go, hey, you know what? Most of these homes that have closed recently have only closed for 850, 875. They're probably a little bit aggressive. And then we have that conversation. Whatever we decide as a team to go move forward, whatever you guys decide to write the offer in and say you get to escrow, your level of protection that you also will have is going to be an appraisal. An appraisal is when you have a third party where the lender will hire a company to come out and look at the property and do a value report evaluation to make sure that whatever you're offering meets the true value. So let's say that the home is worth 800,000. You guys want it so bad, you just want the seller to accept your offer. So you write $1 million. You're like, I'll give you $1 million for your home, right? Well, then realistically, the lender's gonna be like, wait, I'm glad you told them you wanted to give them $1 million, but it's worth 800,000. So now you know that there's gonna be a $200,000 gap on it. And then there, you could either follow escrow because now the seller is saying, hey, now you owe me an extra $200,000. So that's something that we really work on avoiding with our clients and just managing the expectation. But you do have that. You're never going to overpay for the property. One, because properties, like I said, over time historically are going to appreciate. And second, you do have layers of protection with the appraisal, us looking at the comparables, and then you have the lender who's not gonna wanna loan more money than what the property is currently worth in the market. And wanna see if what else? Yeah, that's it. And really quick about supply, and I think this is it, you guys. For Southern California, we're in a really interesting state, compared to maybe a couple others, in the state that our inventory and demand, our demand here is really high. It has always been really high, and that's what keeps our market, I would say, healthy, meaning healthy in the demand area. Our supply is lower because, as Marisol pointed out, some people just don't want to move or are not sure where to move, but we are at like a 2-month supply right now. So when you start thinking about, well, I'm going to wait, until either interest rates drop or maybe prices drop, that inventory is telling you that, and it's been this way for a few years now, it doesn't look like it's getting any better, that as soon as interest rates do drop, the price points are going to get up even higher, right? It's gonna get more competitive. So if you can buy right now, because even that slight on the interest rate, you can refinance it when it gets better, but you can't change the demand and price point as you move further on. So,
Can
makes
we-
sense? Go ahead.
Yeah, can we talk about we just had a listing and we had how many offers we got on our new listing? Because people think, oh, rates are at 7.25, nobody's buying.
So
We saw
the
vendors.
the comment that Brenda made, is to share with everyone that people believe because interest rates are at 7.5, have gone to 7.5, they're not right at this moment, but anywhere for 7, that no one's buying. Like, who can buy? Like, of course, like homes are sitting, there's gonna be price drops. We have a listing in Belmont Shore and also in price points too, right? That in Long Beach, that we listed at 1.175. And just after one weekend, just after one weekend, we had multiple offers. We got 3 really strong offers that are now over the list price. And so that just goes to show you, it's on every level as far as properties go. Like, people are buying because the inventory is short and there's still more buyers out there, right? And not as far as like to be fearful of like, oh my gosh, that means we're never gonna get health. It's just the point that you don't wait. Like, if this is your goal and it can make it work in your lifestyle, you need to continue living your lifestyle and also building equity. Just like I made that point in the very beginning, is that you can keep paying rent, and then 7 years from now, your financial wealth status is exactly the same, if not worse, because rent has increased and now you have 0 equity, right? Start somewhere. That's our job, is to say, start somewhere, because for Brenda and I, and even Marisol saying, we have worked with clients, being in this industry, we have worked with clients now for the last 14 years. I can't tell you how happy it makes us to still be in communication with our clients, to watch them grow, to watch them buy more property. And Natalie as well, to be able to see her clients get into their first home and know that they're building equity right off the bat. It makes us so happy, I can't even tell you, because we see it firsthand, and we know that they're just getting set up to win. And not all of our clients, most of them, they don't start off on that big, beautiful home their first time. That is wrong. That is not the idea. A lot of our clients started off small, and that's okay. Start off small, and you will be able to grow into something a little bit bigger and better. So if anyone has questions about that, go ahead.
So I'm still learning like terminology and all that.
Yes.
So when it comes to refinancing, so you're saying, let's say a house is going for 800,000, right? And the rate is, I'm just making numbers up, like, I don't know, like 7.5, like you said.
Okay.
So in order for me to refinance, it would have to drop to like what, 5, and then I could be able to refinance that rate, or no?
So the question is,
When can you refinance?
when can you refinance if you buy a property? If you buy a property at 7.5%, when can you refinance? Is that
Yeah.
correct? All right, so I'll give it to Marisol.
Yeah.
because she was just saying that again.
Yeah, so to answer your question, it has to make sense for you to refinance. So what that means is, let's say you lock in an interest rate at 7.5.
Mhm.
And the rates drop to 6.5. And we calculate your payment, and you're gonna save $400 a month on your payment. Then it makes sense for you to refi. So you can do it right away. So there's no waiting period. As long as it makes sense for you to refinance, there's not a certain percentage that needs to drop. It doesn't have to be a whole percentage. Sometimes for some people, even a quarter makes a huge difference on their monthly payment. It just depends on the purchase price. I've seen clients that, They bought in the millions and the rate dropped a quarter and that made a substantial difference in their payment. So it just really has to make sense for you. There's no rule of thumb and we just calculate it. We look at the cost associated with refinancing because there's obviously lender fees, appraisal fee, escrow fee, title. So there's going to be about a certain percentage of cost associated with. So we take a look and see if the costs outweigh, what you're going to get in benefit in the savings, monthly savings. And for the most part, it will make sense.
So refinancing only affects the rate, not the price of the actual home, right?
Right. So refinancing only refinances your total loan amount that you owe. It gets paid in full into a new interest rate note, and that gets amortized into a 30-year loan or whichever term that's accepted. The price of the home is negotiated upon purchasing and how much down payment you're giving. So that's when you determine the price of the property. And then it gets evaluated by an appraisal, which is a third-party independent company that gives us their estimated opinion of the value of the home.
I thought a question that maybe it comes to, and I don't know if this would be the next question or in line, is you buy a home and you're on a 30-year and in 5 or 7 years from now you refinance. Or, does that restart the clock to another 30-year loan if you're taking a refinance at 30-year loan?
We're gonna go there,
That's a good question. So no.
yeah.
Actually, this is the good news about it is that there's different terms that we offer. We offer 30, we offer 20, we offer 15, and we offer 10, right? So if you have a 30-year loan, you've been paying on it for 7 years, and then you refinance, you restart the clock. It's all up to you. Do you want to do another 30-year loan, have a better payment? Yes, the clock gets restarted. Do you want to go down to a 20-year loan and cut off 3 years off the payment? Your payment might be the same. However, you're cutting off 3 years from your term. Yes, it makes sense. It just depends. Yeah, once you're ready to refi.
But the lower the term, the higher the payment.
Yes, lower the term, higher the payment.
Right? It's like if you want a 5-year loan, it's like, great, you're gonna have to pay for it. That means you're gonna pay off your house in that term.
Yeah.
So initially, let's say I go in for a 30-year loan, I pay 15 years of it off. And there's an interest rate that drops like significantly. And I decided to just cut some years off, I'm still paying the same payment. Can I do that or does it restart?
So his question is, I've been paying my loan for 15 years and 15 years down the line, now I can cut and the rate drops. Can I cut my payment? Yes, you can cut your payment. You can actually keep making the same payment that you were making and pay down the principal. You have options to pay down the principal when making loan payments. Extra money. They say that if you make one extra payment a year, it reduces your payment by 3 years, your term by 3 years.
Oh, 13
So,
payments?
yeah.
13 payments?
So if you make that 13 payment plan, just make one extra a year. And you can break it off every month. You give an extra X amount of money, or you could just do a full payment and put it towards the principal. Yeah. Good questions.
Oh yeah, great questions. Okay, so that is done. We're gonna go a little bit more into how I protect it. Natalie's going to go through that. I know I talked a little bit on appraisal, but there's obviously some different steps also.
A question just came in.
Oh, okay.
On that. So it says,
Give me one
I should have asked this
Okay.
earlier. Apologies. That's okay, Jimmy.
You want me to read it?
Um,
Natalie, let's read the question.
so the question is, if I'm looking at a home purchased internationally, can you still get a loan? Can you still take a HELOC? Or is all of this information for loans for US home purchases?
That's
a great
really
question.
Yeah.
Okay, I'm gonna cut that in pieces. If you own a home in California and you want a HELOC, yes, we can help you do it. If you're looking to purchase a home internationally, we don't do international lending. We do out-of-state lending, which means any state we can refer you or we can do the loan for you. So we do anything in the United States with the exception of New York. And the reason why New York is not really one we do is because there's a lot of co-ops, there's a lot of high rises, and there's a lot of like different terminology when it comes to their legal documents. And we don't do Hawaii either because there's a lot of protective on there. But internationally, we don't do lending. We do lending on your home equity line of credit as long as your primary residence is in California. And what you do with that, it's up to you after the loan has closed, right?
So if I get a HELOC for $250,000 and then I decide I want to buy a house in Mexico, I can totally do that because I have that line of credit for $250,000, right?
I guess the best way I can say is you can do whatever you want with the
Okay.
money after the line has closed. So
Perfect.
You just answered my question.
Yeah.
That was great. Good question.
Thank you.
Okay,
All
thank
right,
you.
Natalie's up.
Okay. All right, so next question that we hear a lot is, how am I protected? And what am I protected from, right? So when you enter escrow, the way that I like to explain it is it's almost like you're on a road trip. So the start of the road trip is when you're first putting in an offer and you get your offer accepted. And then the end of the road trip, the final destination, is when you close escrow and now you have your keys. So I like to say it like this because there are 3 different contingencies that happen throughout the life of an escrow. And these contingencies are kind of like roadblocks, right? So when you first put in your offer and you get into escrow, one of the first things that's gonna happen is you're gonna put down an initial deposit. And we call that the earnest money deposit, which is typically around 3% of the total purchase price. And this goes into an escrow account, which is a totally neutral third party. And it's a good faith deposit, basically saying, I'm serious about this. I want to go through with this home purchase. So that money is there, basically just letting the seller know, like, hey, I'm serious, let's do this. So once you get to that point and escrow is open, the first roadblock here on your road trip is going to be the inspection contingency. So when you're first looking at properties, you know, you see the new carpet and you see the new paint and you see the lighting and everything that's very cosmetic and surface level. But during this time is when we get to go in and do all of our investigations. So these investigations include a general inspector who's going to go in and he's going to look at everything from the roof to the foundation to plumbing and all of that kind of stuff. But then we also send in some specialists, like a plumber who's going to actually look at the sewer lines that lead to the street. We're going to call someone that's going to do an HVAC inspection, termite. There's a lot of people that we bring in because we want to make sure that you know exactly what it is you're buying. Those are things that you can't just see looking, at the house on Zillow or anything like that. So let's say something comes up and it's a little bit too much for you guys to want to continue in this process. So let's say, oh, it turns out the roof is crumbling. This inspection contingency is going to make it so that you could say, okay, well, hold on. That might be a little bit more than I'm willing to buy because it's going to be a big cost afterward, right? So that inspection contingency is protecting you from having to go through with this purchase. So let's say that everything's fine, some minor things, but nothing crazy. Well, now we move on. So we continue down the road. The next roadblock or contingency is going to be the appraisal, which Vaughn spoke about, which is basically, the house is listed for 700,000, you offer 750. This third party appraiser is going to go and then decide whether or not they believe that the house is actually worth 750. So if they decide, yeah, that's worth 750, well, then we can lift that contingency or that roadblock and keep on going. If they say, hey, we don't really think it's worth 750, we think it's worth 700, again, now you're protected by that contingency, because now that's when we do our job and we go back to the seller side and we now negotiate until everyone's happy, until we're at a number where you're willing to pay, the seller is willing to accept it, and then we can continue on our journey. And there's a couple other things that can happen there too, but we can talk more about that later. So then once we get past the appraisal contingency or roadblock, now there's one last roadblock that's going to protect you here, and that's going to be the loan contingency. And now, Marisol, I don't know if you want to add to this, but for the loan contingency, basically, while we're doing our inspections and we're doing everything on our end, on the back end, the lender and the bank are going to make sure that, again, this house is actually worth what you're paying for, but also that they're willing to loan you this money to make this purchase. So they're going to go into your finances, they're going to go into your employment history and just really dig deep to make sure that they believe that you will be able to pay this loan and that you're going to be on time with your payments and everything like that.
I think, I think the only thing that I'm going to add to it is at the very beginning of the process, I didn't mention it in my presentation, and something I should talk about is the pre-approval. So when we pre-approve you for a home loan, we're telling you based on the information you provide us your pay stubs, W-2s, your bank statements, and we pulled your credit. This is how much you qualify for. But once you're actually in escrow, you actually get reviewed by an underwriter, and then they're the ones that give you a final stamp of approval after we've received the appraisal. Because one of the key components that's missing for the final approval to remove that loan contingency is the evaluation of the home. So a lot of the times we get the loan approval from underwriter early on with pending appraisal. So just know that this is something that's being reviewed early on. I get the question, Marisol, why do you need all my documents? I haven't even found a home yet. That's because we want to make sure that once you do find a home, you're very well qualified, you're ready to move forward, and there's not going to be any hiccups that go along the way, because in the roadmap that Natalie's talking about, you have to make sure that you are performing and that you are moving forward and, you know, you're trucking forward and getting this property and getting the loan approved. We don't want that to be a hiccup.
Thank you. And so that's how you're protected throughout this process. The main goal is that, again, we want to make sure that you can afford it. We want to make sure that it's worth what you're willing to pay for it. And we want to make sure that you know as much as humanly possible about the condition of the home, so that when you get to that finish line and you close escrow and you get your keys, you're not suddenly like, oh my gosh, the roof is caving in and the plumbing doesn't work and the air conditioning doesn't work. This is our time to really just make sure that you're 100% certain. And we walk you through this entire process as well as we hit these different roadblocks. We're there to really explain it to you and to make sure that you feel educated and empowered throughout the process, because we want you to really feel like you knew exactly what was happening. You weren't just signing on the dotted line and then all of a sudden you're a homeowner. We really want you to know exactly how it happened and, you know, what it is you're buying. So, and that's our promise to you as clients.
Thank you,
Thank you,
Max.
Natalie. Yes, there's a lot of protections, but you get a lot of people that are afraid, right? To like, what if I change my mind, or what if I, I don't know the condition of the home? Like Natalie says, that's what we're here and to do, is to guide you through the process. I explain it like a roller coaster. She's a road trip, I'm a roller coaster. Because I mean, there's so many ups and downs emotionally, right? With the process, it's exciting and then it's scary and then you're nervous and then you're anxious and then you're happy again. It's a roller coaster, but you definitely don't want to go it alone, and you always want to make sure that you have a real estate professional to help you through the process. And another misconception that we get, and this isn't one of the questions, the next question that I say is, how do I start? But a lot of people ask, well, or say to us when we meet them, oh, I'm looking on my own. I'm looking by myself. Like, I'm the one looking. And I'm like, really? You have time for that? I mean, I know that a lot of people are on third-party sites searching for homes, but like knowing the contracts, understanding contingencies, don't go it alone. There's no reason for you to do it alone. The awesome thing about hiring a buyer's agent is that we get to guide you through the process. And right now, the sellers are the ones that are covering the costs. So we work hard for you, and you guys don't even have to pay for it. Isn't that awesome? You guys get free help really for yourself. So the number 5 is, how do I start, right? So we've answered, there's still, you guys, this is just like the icing, like the tip of the iceberg. There's so much more involved in purchasing a home, so many contracts, so many documents. You heard it today, and it'll take 10, 12 times before it actually starts to sink in. So we always say, when people ask us, how do I start? You start with a conversation. You schedule an appointment with us. We're all very cool, super casual. We sit down with you and let's like, where are you right now? Let's talk about, let's just be honest. Where are you at and where do you want to go? That's where the road trip comes in, right? Because then it is a roadmap. If you're here and you want to get here, well, we're going to teach you, we're going to show you, excuse me, what it's going to take to get you there. But it all starts with the first step, right? We meet a lot of people that wait until they feel like they're ready to buy, and they're maybe still a year, 2 years out, and then they're very disillusioned because they thought that they were ready for it. And don't be. It all starts with a conversation, and we love to chat and to meet. You start with us, and usually what we do is we refer you to Marisol at Financial Partners. And the reason, again, and I'm going to say this again and again, is we know tons of lenders. Some of my dear friends are lenders, love them, but Financial Partners really truly does the best job. Marisol's incredible with her team, and she makes sure to work really closely with you and find what works best for you. And also, because they're so member centric, they're very good with their fees. They're very competitive with their fees. So that's something else when you start shopping lenders, right? You don't know what you don't know, so you don't know what questions to ask. And that's why it's great to start and to work with reputable people. So that's how do I start. And then you schedule your meeting. And I think that's it. Do we have any other questions? online?
Nothing has come through.
Any
Yeah.
questions here?
Any questions here? I know we're a little past 7, so we want to be mindful of our people joining us on Zoom. Thank you so much for being here. We're gonna stick around for questions here, and those of you on Zoom, please reach out to myself, to Vivon, to Natalie. We're happy to schedule a one-on-one. Again, if you don't want to drive, you want to do a Zoom meeting, a Google Meet, we're super flexible, and we work nights and weekends, so we really kind of accommodate.
As you can see.
Yeah, we accommodate to your schedule, and really for us, it's really important that you're happy, because once you're in the BB family, you're in it for life, right? We wanna help you build your wealth. So thanks, everybody. Have a good night.
Thank
See you at the next one.
you. Thanks, you guys.
Yeah. Grab some snacks.
Yeah, grab some food, and if we're here, Marisol's here obviously to answer more questions. It's
Yes.
nice, cause I think in this group.
I like that it's small.
Yeah, and then they know that, I know, they've had the chance to meet Marisol and sit with me, and you've never had a chance to sit down and do a buyer consult too, so hopefully this was just added on and you just keep learning or keep reviewing, the information over and
like
over again.
school.
Yeah.